Welcome back to the Deep Dive, where we transform complex information into essential knowledge. If you've ever stared at your bank statement and just wondered where, like $8 went, or maybe $15, or why that wire transfer ended up costing more than the thing you were actually buying, well, you definitely know the frustration we're here to tackle today.
Yeah, today we are diving deep into that financial undergrowth. It's the place where these small, persistent expenses called hidden bank fees tend to live. So our mission is to strip away the ambiguity, really identify the 10 most common leaks in your cash flow, and then give you concrete strategies to, seal them up.
And they aren't just minor irritations. For you, the learner, managing your money effectively really means knowing that your capital is being used productively.
Yeah.
When we look at small businesses, for instance, those easy-to-miss fees, even if they only cost a few dollars each time, they really accumulate. We're talking hundreds, maybe even thousands annually.
Yeah, and that's money that should be funding inventory or marketing or, just securing personal stability. It shouldn't be silently disappearing into the bank's profitability models. What's fascinating here and a bit frustrating is that the opaqueness often seems intentional. These fees aren't exactly highlighted in adult print, are they?
Not at all. Very deep.
Exactly. They're buried deep within disclosures, often disguised with technical labels. And if you don't know where the money is going, if you can't spot that, say, $7 account maintenance fee or the $35 overdraft charge, you effectively forfeit control. So we are here today to bring that knowledge and hopefully that control back to you.
Okay, let's unpack this then. We are going on a deep dive today to uncover these 10 most concealed bank fees and provide some clear paths to avoidance. We'll start with the foundational issues those fees related simply to, well, keeping your account open.
Right. And just to set the context before we jump into the list,
Yeah.
we really need to understand the scale here. A single $10 fee might seem negligible, right?
Yeah, you might just shrug it off.
Exactly. But if you incur that fee monthly, plus maybe a few incidental charges, like a paper statement fee, perhaps an NSF fee pops up, suddenly you're looking at hundreds of dollars annually just per account. Now, if you operate a small business, maybe you have multiple accounts, checking, savings, possibly a line of credit. These expenses essentially become a silent tax on your liquidity. It just drains away capital.
It really changes the entire philosophy of cash management, doesn't it? It's not just about maximizing revenue and minimizing the obvious costs anymore.
Mm-hmm.
We almost have to become experts in minimizing this internal financial friction.
Yeah.
So understanding the mechanics behind these fees, that's really the first step toward becoming, truly well-informed.
Precisely. We're moving from just descriptive knowledge like, oh, I got charged a fee, to more analytical knowledge, understanding why. I got charged this fee because my bank structures its business to prioritize, say, deposit stability or infrastructure cost recovery. That insight is what allows us to then pivot, to maybe find providers whose business model actually aligns better with your needs as a user.
That sets the stage beautifully. Okay, let's jump right into the specifics then. We'll start with category A, operational and balance-related fees. Okay, first up. This one seems almost universal, yet interestingly, it's consistently waived by alternatives. Number one, the account maintenance fee.
Yeah, this is your basic monthly service fee. It's essentially a mechanism for the bank to cover its fixed operational costs, the costs associated with maintaining the whole account infrastructure.
Like what specifically?
Well, we're talking about human cost tellers, customer support staff, the physical costs of branches, which are still significant, and increasingly the huge IT and security infrastructure needed for digital banking and, importantly, compliance. And because it's automatically withdrawn each month, it's just so easy to overlook. Banks rarely, if ever, itemize what specific part covers cybersecurity versus, say, teller salaries. It's just a blanket charge.
And it's frustrating because it often feels like you're being penalized just for having an account with them.
Uh-huh.
So what's the counter? How do you avoid this one? Is it avoidable?
Oh, absolutely. This is actually one of the most negotiable and avoidable fees out there. Banks are generally reluctant to lose a customer over a relatively low monthly fee, so they typically structure waivers around, say, customer loyalty or specific usage habits. To avoid it, you should look for accounts that waive the fee if you meet certain simple requirements.
Like what kind of requirements?
Things like setting up a recurring direct deposit, maybe maintaining a certain number of monthly transactions, or linking a qualifying checking account. The key insight here is that the bank waives the fee because your activity or the liquidity you provide makes you profitable in other ways, effectively offsetting that operational cost for them.
Okay, that makes sense. You scratch their back, they scratch yours, fee-wise.
Pretty much, yeah.
That effort to provide liquidity leads us directly into fee number two, the notorious minimum balance fee. Sometimes they call it the fall below fee.
Right. And this fee gets triggered the instant your account balance dips below a specific threshold set by the bank. Could be $500, could be $2,000, sometimes even $10,000 or more. And again, this isn't just arbitrary punishment, it's tied directly to some pretty high-level banking requirements.
Okay, let's elaborate on that. Why?
hmm
Why is the bank so obsessed with me keeping, say, $5,000 sitting in my account?
It's absolutely crucial for their regulatory stability. Banks have strict requirements, things like capital adequacy ratios, and very importantly, liquidity coverage ratios, the LCR, which are mandated by regulators like the MAS in Singapore or, similar bodies globally. These ratios dictate how much liquid, readily available capital a bank must hold relative to its overall risk exposure. So, when you maintain a large, stable deposit, you're essentially contributing to the bank's low-cost funding base. This stability improves their overall risk profile, it makes their borrowing cheaper, and it enables them to meet those critical regulatory LCR targets. So by charging this fee, the bank is basically incentivizing you to help manage their regulatory compliance burden. If you don't provide that stable deposit they want,
They penalize you.
they penalize you, yeah. Essentially to cover the administrative cost of managing what they see as potentially volatile, smaller accounts.
So if your business cash flow fluctuates wildly, which many do, trying to maintain some arbitrary high minimum balance becomes this really stressful and potentially expensive game.
Exactly.
So the avoidance here seems to require that upfront homework again. Only sign up for accounts where the minimum balance requirement is comfortably within your average operating balance. Or, even better, find an account that just doesn't have one at all.
That's the ideal, yes.
Okay. Moving to fee number 3. This one feels like the truly ironic charge of the modern era, the online access fee, often disguised as the digital trap.
Yeah, isn't it? We live in a world where digital operations should, theoretically, lead to cost savings for the institution, right? You're using their automated infrastructure, saving them the cost of a physical teller interaction.
You'd think so.
Yet, many traditional banks still charge for core digital services. Things like initiating a wire transfer using mobile banking or even just accessing detailed transaction history online beyond a certain point. And they often hide these charges under labels like remote banking fees. This often traces back, believe it or not, to legacy systems. Traditional banks operate these enormous, expensive, sometimes decades-old IT infrastructures.
Right, the old mainframes.
Exactly. And they sometimes justify these fees by claiming they need to recoup the fixed costs of maintaining these older, complex technology stacks. Which, frankly, raises an important question. Why are customers paying a premium for the bank's inefficiency?
It really feels like double taxation sometimes. We're penalized for moving away from the costly physical branch model they want us to leave. So the solution seems pretty clear here. Look for alternatives. Things like the PSPs we'll discuss later, providers that are cloud native, built digital first, they typically don't carry this legacy cost burden, and therefore they can just eliminate these kinds of digital service fees.
Precisely. Their cost structure is fundamentally different.
Okay. Fee number 4. This one's legendary, but oh so painful.
Yeah.
The overdraft fee.
Ah, yes. The bank's most expensive form of extremely short-term lending, really. It happens when a payment or withdrawal exceeds your available balance. Say you try to make a $300 payment, but you only have $270 in the account. The mechanism is straightforward but costly. The bank covers the $30 difference for you, making sure the transaction goes through. That's why it's essentially a loan, albeit a very expensive, very short-term one. But then, almost immediately, they hit you with a steep fee, often $25, $30, even $35 or more, just for the privilege. And that's on top of having to repay the $30 they covered.
Yeah.
And this cost of convenience can escalate incredibly quickly because some banks allow multiple overdrafts in a single day, charging that hefty fee each and every time.
It's like a safety net with spikes in it. You have an unexpected dip in cash flow, maybe a few automatic payments hit at once, and suddenly you've incurred like 3 $35 penalties in quick succession. That's over $100 just gone.
It adds up incredibly fast.
Which is why having those low balance alerts we'll talk about is just absolutely crucial.
Definitely a T defense.
Okay, our 5th operational fee, this one's simpler but still frustrating, the card replacement fee.
Right. This charge is usually applied when your debit or credit card is lost, stolen, or sometimes even just expires and needs reissuing. The fee basically covers the logistics involved.
Logistics.
Yeah, the physical cost of the plastic card itself, the embedded ship, which actually carries increasing security costs these days, and then the labor and postage required for mailing it out to you. Now, what many users overlook here is the critical detail of expedited shipping. If you lose your primary business card while you're on a multi-day trip overseas, for example, you might need it rushed.
Oh, yeah,
Well,
absolutely.
that rush delivery, often overnight or maybe 48-hour service, almost always carries a significant, separate, and specific cost. It can easily double or even triple the standard replacement fee. You really need to know that policy up front, especially if you rely heavily on that card for time-sensitive payments.
Good point. Check the fine print on rush delivery fees. Okay, that covers the sort of fixed costs and the balance-related penalties. Let's shift gears now into Category B, account behavior and transaction-related fees. These are charges tied directly to how you use or, sometimes, how you don't use your account. Hashtag AB. Account behavior and transaction-related fees. All right, number 6 is the early closure fee. This feels like a penalty for leaving too soon.
And that's exactly what it is. It's purely strategic on the bank's part. See, banks spend considerable money acquiring new customers. They often use attractive sign-up bonuses, maybe high introductory interest rates, or valuable rewards packages to lure you
Or
in.
welcome gifts.
Exactly. The early closure fee is explicitly designed to discourage account holders from gaming the system, opening the account, grabbing the bonus or reward, and then immediately jumping ship to the next bank, offering a juicy perk. The timeline detail here is really key. Too soon generally falls somewhere between 3 and 6 months after opening, but some banks might require a full year of keeping the account open.
A whole year. Wow.
Yeah. And if the account agreement stipulates a minimum holding period and you violate it, they will typically try to claw back the value of any bonus you received, plus apply an additional closure fee. So you really have to review the specific retention clause attached to any promotional account you open.
So they want commitment, or they'll essentially fine you for the breakup.
Okay.
And number 7 is kind of the exact opposite problem, the inactivity fee. Here, you get charged for using the account too little.
Right. It's ironic, isn't it? If an account remains untouched, meaning no deposits, no withdrawals, no transactions at all for an extended period, the bank deems it dormant, and then they start levying this inactivity fee. Banks tend to view these dormant accounts as a liability. They require ongoing administrative oversight, primarily because of something called escheatment requirement.
A sheetment, what's that exactly?
Good question. Escheatment is the legal process where banks, if they can't contact the account owner after a certain period, are required by law to turn over any unclaimed or unused property, in this case, your remaining funds to the state or the relevant government jurisdiction.
Really, they just give it to the state.
Eventually, yes. And this whole process involves significant administrative work and legal reporting for the bank. So they try to avoid this complex process either by, forcing activity with a monthly inactivity fee, hoping you'll use the account, or by eventually just closing the account entirely. And the timeline for an account to be deemed inactive is pretty broad. It can range anywhere from 1 year to maybe 5 years, depending on the specific jurisdiction and the bank's own internal policy.
And if they do close the account, but there are still funds in it.
You have to actively contact either the bank or the state's unclaimed property division to reclaim those funds. They won't just automatically mail you a check. You have to pursue it.
Man, it really feels like a financial minefield sometimes. Penalized for opening too fast, penalized for closing too fast, and now penalized for doing nothing at all.
It can certainly feel that way. You need to stay engaged.
Okay. Number 8. This one's critical for anyone doing business across borders or even just traveling. Foreign transaction fees.
Yes, absolutely crucial to understand this one. This fee is applied pretty much any time your transaction requires a currency conversion or is processed through a bank located outside your home country or jurisdiction. This typically hits you in 3 main scenarios. Using your card while you're physically abroad, obviously. Second, when you purchase something from an international vendor online, even if you're sitting at home. And third, sometimes even if a transaction seems local but gets processed by a foreign banking intermediary behind the scenes.
That last one sounds tricky to spot.
It can be. Now let's look at the data for a moment. Our sources highlight that most banks in regions like, say, Singapore, typically charge around 3.25% on these foreign transactions.
3.25%? That sounds like a lot.
It really adds up. If you're a business managing, let's say, $10,000 worth of international software subscriptions or maybe overseas procurement every month, that 3.25% fee translates to $325 in silent overhead. every single month. That's a massive drag on your profit margin over a year.
Wow, $325 a month just gone. That's an exorbitant tax on doing global business or even just buying things online from abroad. What are the specific actionable tips to dodge this?
Well, the two easiest ways are, first, opening a multi-currency credit card, or even better, a dedicated account from a PSP that's built for international transfers. These often eliminate the conversion cost entirely or handle it at the much better interbank rate. And second, a simpler tip. Strictly refrain from using foreign ATMs whenever possible. Those often trigger both the foreign transaction fee and usually a separate, hefty ATM withdrawal fee from both banks involved. It's a double whammy.
Right, avoid the foreign ATMs. Got it. Okay, moving quickly to number 9, this one. This is the paper statement fee. And I have to say, this is arguably one of the most annoying charges because it seems so incredibly easy to avoid, yet banks still generate billions from it globally.
It truly is a modern cost shift, isn't it? Since the digital statement is now the norm, it's easily accessible, it's more environmentally friendly, and critically, it's much cheaper for the bank to generate and deliver. Requesting a physical, printed copy mailed to you is now treated as an optional premium service.
So they charge for the paper and postage.
Exactly. It incurs administrative time for someone to process the request, actual printing costs, and postage. Plus, there's another angle. Banks often want to push customers towards digital statements for security reasons. Physical mail can be lost or intercepted, whereas digital access is generally secured by passwords, maybe multi-factor authentication. So by charging the fee, they're strongly incentivizing the move to their preferred, more secure, and more automated delivery method. The avoidance tip here is incredibly straightforward. Just opt out of paper statements immediately if you're comfortable managing your records digitally. Check your online banking settings.
Easy fix. Just click the button. Okay. Finally, number 10. This one is the close cousin of the overdraft fee, the non-sufficient funds fee, or in SFE, sometimes called a bounced check fee.
Right. And the distinction between this and an overdraft fee is absolutely crucial, so let's analyze it carefully. Remember, the overdraft fee happens when the bank covers your lack of funds and charges you for it.
Right. They pay it, then charge you.
The NSF fee occurs when you attempt a transaction without sufficient funds, and the bank rejects the transaction entirely. They do not cover you. So, for instance, if you write a check or maybe attempt a large debit card payment and the funds simply aren't there in the account, the bank will reject that payment. They'll return the item unpaid.
Okay.
And then they charge you the NSF fee, basically for the administrative work involved in handling that failed transaction attempt.
Wow. That seems like a severe double penalty. You don't actually get the item or service you were trying to pay for.
Correct. The transaction fails.
And you still get fined by the bank for trying. Plus, as you mentioned, you might face a secondary penalty from the payee. Maybe your landlord charging a return check fee, or a utility company charging a penalty for the late failed payment. It just compounds the misery.
It absolutely can. It's a cascading failure effect. The defense here really has to be proactive. The best avoidance tip is to actively use the tools your bank offers. Opt in for low balance alerts.
Those email or text notifications.
Exactly. Set up multiple notification triggers, maybe one alert when your balance dips below $500, then another more urgent one at $100, for example. This gives you a critical, immediate heads up, allowing you time to transfer funds or deposit money before you accidentally trigger either an NSF or an overdraft fee.
Prevention is definitely key there.
Yeah.
Okay, whew. We have dissected the 10 silent enemies. Now let's talk about fighting back. Let's discuss the strategies to combat and avoid these unnecessary fees. All right, here's where it gets really interesting. We know the enemies now, we've named them. Let's discuss the counter strategies. And it seems we have two main approaches: the sort of immediate fix through negotiation, and then the more long-term structural solution through alternative finance.
Yeah, and it's interesting because many listeners probably feel a bit powerless against these huge banking institutions. They might assume that fees are just non-negotiable mandates handed down from on high.
Yeah, it feels like arguing with a brick wall sometimes.
It can, but the power of simply asking is profoundly underestimated, especially when you're dealing with specific, maybe non-recurring fees.
So you're saying the bank might be more willing to reverse a one-off mistake or an occasional fee rather than rewriting their entire fee schedule just for you?
Precisely. Negotiation works best in specific scenarios. The source material we looked at suggests focusing on 3 particularly negotiable fee types. First, overdraft fees.
Okay.
If this is maybe your first time overdrafting, or perhaps it only happens very rarely, say, once every year or two, many institutions actually have an unwritten policy, or at least some discretion, to waive it as a gesture of goodwill. This is especially true if you've otherwise been a reliable, long-term customer. We're talking success rates potentially approaching 80% if you call them quickly and ask politely.
80%, that's surprisingly high.
It is for that first-time offense or rare occurrence. Second, account maintenance fees. We talked about waivers earlier, but even if you don't automatically qualify, if you're consistently close to meeting the minimum balance or the activity requirements, it's worth calling your bank manager. Explain your situation. Maybe cash flow is tight this month, and you can often get a temporary waiver or maybe an adjustment to the requirement. And third, transfer fees. Especially if you're a high-value client or a business doing frequent transfers, those inter-account or recurring wire transfer fees can sometimes be negotiated down or perhaps even waived entirely just to maintain your business relationship.
Okay, so for those three, overdraft, maintenance, transfer app, it's worth asking. But how should the listener approach this call? Do you just talk to the first customer service rep who answers the phone?
That's a critical point. For best results, don't just stick with the entry-level customer service agent. They often have limited authority to waive fees. You really need to politely but firmly ask to speak to someone with more discretion, maybe your retention specialist, or even your local branch manager if you have one.
Go up the chain a bit.
Exactly. You're essentially asking them to make a business decision. Is keeping you as a customer worth more to them than the, say, $35 fee they just charged? And use professional language. Something like, "Hi, I've been a loyal customer for 5 years, and I see I incurred this overdraft fee yesterday. I understand why, but I was hoping you might be able to make a one-time courtesy adjustment to reverse it for me."
Framing it as a courtesy and exception.
Precisely. It frames the request as an exception based on your relationship, not as an entitlement or a demand. That professional approach goes a long way.
That human connection, or at least that request for human discretion, can be really valuable.
Yeah.
But what if negotiation fails? Or what if you're just plain exhausted by having to call and plead your case every time some penalty hits your account?
Right. Negotiation is a good first step, but it's reactive.
Yeah. That brings us neatly to strategy 2. Actually changing the playing field, moving beyond just asking for waivers.
Exactly. If the traditional banking model consistently penalizes your specific cash flow patterns or your business activities, then the truly effective long-term solution is often to move to a financial model that actually rewards or at least doesn't penalize your activity. And this often means exploring alternative finance providers, specifically things like business accounts offered by payment service providers or PSPs.
Okay, we hear the term PSPs mentioned a lot more these days. For the listener who might not be familiar, what's the crucial context we need about them? Are they, as safe or reliable as traditional banks?
That's a really important question, and the context is vital. PSPs are, relatively speaking, technological and philosophical newcomers to the financial scene. They're typically built on lean, modern, often cloud-based infrastructure. Critically, in established financial hubs, they have earned regulatory acceptance and oversight. For example, in a place like Singapore, many PSPs are recognized and supervised by the Monetary Authority of Singapore, the MAS.
Okay, so they are regulated.
Yes, although their specific operational licenses might differ slightly from a full traditional bank charter, they operate under strict regulatory guidelines designed to ensure security, solvency, and compliance. But the key difference, and this is the insight that helps eliminate those hidden fees, lies in their fundamental business model. Traditional banks primarily earn revenue through what's called the deposit spread, basically, lending out customer deposits at a higher interest rate than they pay depositors, and then supplementing this core income heavily with fees like account maintenance and minimum balance fees.
Right, the fees prop up the model.
In many cases, yes. PSPs, on the other hand, often rely more on high transaction volume and things like interchange fees, the small percentage fee charged on card transactions.
So their profitability is tied more to usage and activity, rather than just sitting on large deposits or hitting you with penalties.
Precisely. And because their underlying infrastructure is usually entirely digital, relying on cloud computing, their operational costs are significantly lower than traditional banks that have to maintain hundreds of physical branches and deal with those complex legacy IT systems we talked about.
Fewer overheads.
Much fewer. And since they don't depend on attracting huge minimum balances for LCR compliance, and they don't have the cost of physical branches for service delivery, they can simply eliminate many of the fees tied to those old, expensive cost structures.
That elimination of friction of those constant little charges sounds incredibly powerful, especially for a small business. The source material we reviewed provided a detailed case study using the Aspire business account as a kind of model for what listeners should look for if they consider making this shift. What does that kind of transparent model deliver in actual practice?
Yeah, the Aspire example is a perfect illustration of this new financial architecture in action. Because it operates completely online and is often targeted towards small, digitally savvy businesses, it directly tackles those major pain points we identified. By removing those legacy cost structures, it can offer things like zero monthly fees, zero fall below fees, and zero minimum balance requirements. Think about that the bank, or in this case, the PSP, doesn't need your large, stable deposit for its LCR compliance calculation, so they just remove the penalty for not providing it.
That alone must be enormous for businesses with seasonal income
Yeah.
or just generally variable cash flow.
It's a game changer. The PSP model allows the user to operate their cash reserves much more efficiently without the constant stress of maintaining some arbitrary mandated threshold that might not fit their business cycle.
And beyond just the cost elimination, getting rid of those negatives, there's also often an added incentive, which kind of flips the whole script entirely, doesn't it?
Yes, exactly. Instead of merely helping you avoid penalties, the more advanced PSP models actively seek to reward core business behavior. In that Aspire example, they offer things like 1% cashback specifically on qualified digital marketing spend and software as a service SaaS subscriptions.
So things businesses spend on anyway.
Right. Critical business tools. This means the account doesn't just save you money by cutting out all those annoying fees. It can actively generate revenue, or at least offset costs, by rewarding smart spending. It fundamentally transforms a financial platform from being just an expensive gatekeeper into potentially a strategic business partner that contributes to your bottom line.
It really is a complete rethink of the relationship, isn't it? By consciously choosing a provider built on transparency in a modern operating model, you're essentially sidestepping that entire suite of 10 hidden fees we just spent the last, half hour or so discussing.
That's the potential. Yes. You're opting out of the old fee structure. Hashtag tag outro. So to kind of synthesize this whole deep dive, I think the core takeaway is this. Critical thinking is probably your most valuable asset when dealing with your finances. You really need to understand the purpose behind every single fee you encounter. Ask yourself, is the bank charging me this fee to recover their old infrastructure costs? Is it to secure deposit stability for their regulatory needs? Or maybe it's just to claw back that sign-up bonus they offered. Once you understand the why behind the fee, then you can make a truly informed choice. You can select financial institutions or providers whose models actually align with your operational needs, rather than just, passively succumbing to a legacy fee structure that doesn't serve you well. Knowledge empowers that choice.
Precisely put. And if you're running a business or even just managing personal finances tightly, saving even those small accumulating fees, the $10 here, the $35 there means more money that can be directed toward actual growth or inventory, better hires, paying down debt, or just building greater financial stability. We're really talking about maximizing every potential stream of capital you have. Okay, so as our final provocative thought for you to take away and maybe mull over this week, we challenge you. Actively pull up your last 3 bank statements. Seriously, do it tonight or tomorrow. Take this list of the 10 most common fees we discussed today. The account maintenance fee, the overdraft or NSF charge, that foreign transaction penalty maybe, and literally circle every instance you find on those statements.
And then question which of those costs you could potentially eliminate, maybe starting right now. If you call your bank tomorrow morning and politely negotiate that last overdraft fee based on your history, could you log into your online banking right now and switch your paper statements to digital in under 60 seconds? See just how much money you might be able to put back into your own pocket simply by applying some of the knowledge you gained today and maybe making a few small adjustments to your accounts or your behavior.
It really is all about making your money work for you, not just enriching a fee structure that might be outdated. Thank you so much for joining us on this deep dive into the often murky world of hidden bank fees. We look forward to exploring the next big topic with you soon, right here on the Deep Dive.
When you're back, make your